Corey, good afternoon. How are you?
Ryan, thank you so much. I'm great and delighted to be doing this.
I'm so excited. The fact that you and I had not been formally introduced or crossed paths up until recently is somehow a shock and miracle to me. But I'm so excited. Understanding your background, you've been at this for a long time. I think you could be credited probably as the father of employee ownership or the grandfather, however you want to be labeled at this.
Uncle maybe.
Oh, there you go. I like it. So I'm very excited to be speaking to you because of how much history you have behind this topic of employee ownership. And Corey, when you had sent me the LinkedIn message about your book and your passion behind reinventing capitalism through employee ownership, I was like, oh my gosh, I can't wait to talk to Corey. So for the listeners that might not be aware of you or your background, you want to just kind of give us a 50,000 foot overview of what you've been up to?
So again, my name's Corey Rosen, and I'm the founder of an organization called the National Center for Employee Ownership. We are a nonprofit, 501c3, that specializes in providing really good information about how all forms of employee ownership work. But we focus on broad-based employee ownership, not just ownership for executives. I started the organization in 1981. Prior to that, I'd worked on Capitol Hill and drafted some of the pieces of ESOP legislation. And prior to that was an academic.
And you've been at this for, like you said, since pretty much almost the inception. What got you so intrigued with the entire topic of employee ownership, Corey? Because I think about in the context behind the question is like now, especially with the book and the concepts that you're talking about now, it's becoming, I think, very obvious why there needs to be a change. But back then, like what got you onto this?
So I was bored one day in my job as a Capitol Hill staffer. And if you're really bored, you might be desperate and read the congressional record. And there was this testimony at a hearing by a very famous professor, William Foote White. And if anybody had taken sociology, they'd read his book, Street Corner Society. So I knew who he was. Well, I should read this. And it was a testimony about employee ownership. Employee ownership, what's that? And I was fascinated because I always wanted to find some cause to work for. That was the only thing that really interested me, was to find something that could make the world better. And working on Capitol Hill, you realize very quickly that if you're really going to make change, that two criteria need to be met. One is that the idea actually needs to make a difference to people. And the second is it needs to be politically doable. There are lots of ideas that are one or the other. There are only a few that are both. And that's even more true now. But employee ownership looked like one of those ideas that, well, Republicans can like this because it's more capitalist. And Democrats can like this because it's more social justice. I also thought, well, if the employees own the company probably will perform better. That's good for everybody, good for the communities, good for the companies, good for the employee owners. And if the employees own the company, they'll have more wealth security, and maybe they'll be treated with more dignity and respect at work. And if they're treated with more dignity and respect at work and have more voice, well, maybe the company will actually perform better, and we get into this wonderful virtual circle. So I thought this is a really interesting idea. At the time, it was a very new idea, and not very many people knew about it. The legislation that created it had been created just 4 years earlier. So there was a long way to go. So that's how I got interested. And I was hooked and really pretty quickly decided I'm going to figure out a way to spend my life on this.
Was there anything in your background that because I love the long noble purpose, because then it just can make one heck of a fun life. I really I really am aligned with you on that. Was there something from your background where this topic seemed like an interesting horse to ride?
Well, not necessarily. I was a political scientist, and one of the things that was a very current idea at the time was that democracy through government was being replaced by corporations, multinational corporations, that had tremendous power, really quasi-governmental power. And an issue was going to be emerging, and already was emerging then, that democracy might be threatened by those sorts of emerging power sources. And we were already starting to see a phenomenon that, of course, has really grown on steroids since then, we can talk more about, where wealth was concentrating in the hands of fewer and fewer people, especially at the heads of these companies. So how do we change that? Well, one way we could change that is by making the corporation itself a more democratic organization. I don't mean that the employees are electing the board and running the company, but that they have voice and that somebody will listen to them about their ideas. So when I saw employee ownership, that really resonated with this broader concern.
I can't even, like, all of those reasons and why I'm passionate about this. I can't even imagine what you've watched happen over the last 40 years of where the power and the inequality has, I mean, capitalism, democracy is in jeopardy. And
It really
I'm agreeing.
is.
Yeah. And like the real, like really influential people that I follow are starting to, to sound the alarm as well. And I want to get to that. But first, kind of going back to so you had said the legislation had passed 4 years prior to you jumping on it?
1974 was when the big legislation that created the main form of employee ownership, not the only, but the main form, the Employee Stock Ownership Plan, or ESOP, was passed. And that would prove to be the first of 17 different bills that would be passed over the ensuing decades to encourage employee ownership. Interestingly, if you look at all those bills, and there are some states that have passed employee ownership laws recently as well, a very encouraging trend. If you look at those bills, every single one passed either unanimously or maybe there was some stray opponent here or there. This was the kind of thing that Ronald Reagan and Ted Kennedy thought was a good idea. As a friend of mine once said, it's the only thing all three Jessies, Helms, Ventura, and Jackson, ever agreed on. Most recently, there was a bill whose primary sponsors were Tommy Tuberville and Elizabeth Warren. I don't think Tommy Tuberville and Elizabeth Warren will ever be on the same piece of paper ever again.
Yeah, do they even agree what color the sky is?
Yeah,
right. Isn't it? Keep going.
So the legislation really was just sort of creating the core framework. And then over the years, more and more incentives were passed around employee ownership. So the political viability of the idea really has been established over and over again.
It's actually the running joke when I do our boot camps or the virtual academies, Corey, where I'm like, it's the only thing that's bipartisan these days, and everybody laughs because it's actually the truth. And there's so much control within the power of the entrepreneur who can create a good company too. And I just love, so Corey, here's as we unpack this topic of ESOPs and incentives, ownership, and I'd read the excerpt from your book. I literally love it. I get super passionate, Corey, about incentive alignment. I would say that's one of my driving forces of because unpacking where are things misguided, because people will run like crazy through walls towards their incentives, and then you realize after a long period of time when the incentives are off basis. And I think that's what we've watched over the last, a handful of decades of those incentives that were set up in the structure of the system have been being executed by people, which have led to this. You had worded it like the quilt of ownership, or I can't remember how you worded it. You want to explain just this broad base in ownership, your thoughts on ownership?
Sure. So let's think about where we are today with the concept of ownership, capital ownership, and where we've come. I think a lot of us grew up, and maybe still do, with the notion of capitalist ownership is the person who starts a business and owns the company, or maybe the investor who invests in a company with a long-term perspective. Those things obviously still exist and are still really important parts of the economy, but they're not the main attributes of capital ownership today. You've got three. You do have that element of the privately held companies owned by individuals or families, often with long-term investors. And that's a significant part of the economy. But the two bigger parts of the economy, at least one is bigger and one is approaching as big, are public company ownership. And I want to put that in quotes. What does public company ownership mean? Well, for most of us, it's something we invest in the 401k plan. And we are owners in much the same way that somebody going to a racetrack and betting on a horse is. We're not invested in the company. We're gambling on the company. We don't vote the stock. We don't follow the company closely. But a lot of the ownership, most of the ownership in public companies is either held by a small number of very wealthy individuals. There are three families who own more wealth than 40% of the population owns collectively.
Can I guess?
99% of the wealth is owned by 1% of the capital ownership is held by 1% of the population. And so a lot of the individually held wealth is owned by a very small number of people in public companies. Much of the rest of it's owned institutionally by pension funds and other institutions. Do they own the stock? Well, most of their trades are algorithmic. And that means that literally these shares are held for fractions of a second.
Have you ever read Flash Boys by Michael Lewis?
I have, yes. Yeah.
Oh my God. Just like when they were talking about trenching pipelines across the country did they get them as straight as they can for nanoseconds?
Right. And that really, he makes that point. This is not ownership. This is a very sophisticated form of gambling. Well, what if you're one of the CEOs of those companies? You think, well, I'm going to pay attention to my shareholders. What shareholders? The shareholders don't vote. I mean, they could, but they don't. When there are elections, it's vote for 5 of the board members. The way that your shareholders express satisfaction or dissatisfaction is selling the shares or buying the shares, which they do based on very short-term expectations. I mean, think of
literally memes, right? Like that's what we're doing with memes.
Could be nanoseconds. But for other investors, it's the next quarter is the long term. So if I'm a CEO of these companies, do I want to focus on the long term? Well, not if I want to keep my job. And by the way, the median tenure of a CEO in a public company is only 5 years anyway. So you have a system, highly concentrated wealth, and very short-term focus. The second major ownership structure, other than the first one we talked about, is private equity, which is a growing part of the total ownership of the economy. And private equity's model is, let's go buy a company and we'll flip it in 3 to 7 years.
To Blackstone.
to another company. Increasingly, that's the case, is it's sold to another private equity firm. Used to be at least they were sold to a real company, but increasingly they're sold to another private equity firm that does the same thing. And so what do you want to do? Well, you want to increase profits as quickly as possible during the short term. If that means laying people off, cutting benefits, not investing in R&D, so be it. And their time horizon, as I said, is 3 to 7 years. And the ownership in private equity firms, of course, is also highly concentrated amongst highly wealthy people. So you have a system in which increasingly wealth is concentrated. On the other hand, you have employees and ordinary working people, families, who say, I can't put my hands on $1,000 in an emergency. That's half the population. Where the median retirement assets for somebody 54 to 64 is just over $100,000.
Oh, Corey, I saw that. Was it the Bloomberg article? Because I know that these stats have been rolling around for a handful of years now, but there was a Bloomberg one that came out recently, and it was like, what was it? Like 0.1% of the country has maybe $5 million saved up, which is like kind of what people are striving for, the nest egg. And you're like,
no, 5 million. Yeah. It's those people could fit in a football stadium.
It's like, I shouldn't be laughing. That's terrifying. I mean, it's ridiculous.
Well, yes, that's terrifying. But it's more terrifying people don't have 150,000, let alone 5 million.
Right. Yep.
And that's most people who are at retirement age. Plus, that looked at people who have retirement assets. 50% of the private sector workforce is in no retirement plan at all. This is a disaster. And the wealth insecurity that creates, think of that from the perspective of these people. How are they feeling? Well, it's bad for their health to feel that economically insecure. So health outcomes in this country are getting worse and worse, and we're seeing, all sorts of crises with health and drug use and so on. You're also seeing, and this gets to the point about democracy, people saying, it's not fair. This is a core human element. Let
me comment on that, Corey. I've got twin daughters, and this topic of fair is like literally the only thing that I have to talk about on a daily basis. And it's so interesting how that is so core to all of the things you're talking about.
Just what I was going to say, that if you have kids, or you were a kid, or kids, and you think of something whiny that kids say when they're like,
not fair, Corey.
It's not fair. And so we grow up and we say, you know what? It's not fair. And that's created an enormous amount of anger in the population generally. And we're seeing the expression of that anger in the political and social dissolution that the US and other democracies have been facing. And I'm not saying, well, these people have the solution or those people have the solution.
It's just a fact of what we're seeing.
People on the left and the right are really pissed off. And deservedly so. So how do we find solutions? And why did this happen in the first place? Just to wrap this up, when I first started learning about this idea, I remember in 1973, when I was just starting my first teaching job, I actually saw Louis Kelso, who's the real father of ESOPs. Louis Kelso was on 60 Minutes with Paul Samuelson, who was this famous economist at the time. And he was explaining his idea of employee stock ownership plans. And Kelso said, the problem is that as we go through the next few decades, that people who own capital are going to get richer and richer and richer, and people who work for them are going to struggle to stay in place because the traditional link that had always been there in capitalist economies, that when capital investment went up, wages went up because people were more productive and you could pay them more. He said that's going to break because the pace of capital change is going to accelerate so quickly, labor won't be able to keep up. Paul Samuelson said, you're nuts. This is just a wacky idea from some lawyer, not an economist. It's never happened and it never will. So that was 1973. What happened? Well, real wages, inflation-adjusted wages since 1973 have barely moved. Although some of the things that we have to spend money on, even though we're adjusting for inflation, some things that we never thought we'd have to spend money on are very long-term health care because we're living longer, or cell phones, or cable TV. There are all these other things now that have become necessities in life but we don't have any more money to pay for them. At the same time that wages stagnated, returns to capital in real dollars grew about 8% a year. So that's why we saw this enormous and growing gap between the few very rich and everybody else.
Well, and as we continue to unpack this, I want to introduce just an analogy that I think, or metaphor that I think people resonate with, Corey. Is like when we think about our houses. I mean, our homestead is the largest asset of most Americans,
right?
And let me comment on a couple of things. I just want to hear your responses to some of my, because these are the things that swim around in my head as I think about the same picture that you're thinking about. Is so behavioral economics, so misbehaving. When behavioral economics came in, we're not automatons that just do exactly what the economists say. We're rational creatures. We all know that, and human beings don't save for the future. So when they introduce that checkbox on you immediately start funding your 401k. It went from 12% people funding it to 80% because humans are just lazy. And where I'm going with this, Corey, is I say, okay, well, that proved that you can help humans make good decisions by putting things in their life that are just natural. And so when I think about our homes, right, the home or the dream of the American is to own a home. Well, when you own so as long as you have enough money for the down payment, and then you get your house, let's say it's $2,500 a month. And as long as you live there for 20 years, you're going to own your home and it's going to grow in value. So just by living your life and having time extrapolate, you're not just giving that ownership to the person that owns the house. If you're renting, it is actually going to growing wealth. And when I think about an ESOP, it's the same damn thing. It's someone works for 20 years and the asset grows in value as long as they got that ownership. But all of that time that is spent, if they don't own the asset, it goes to someone else. It's just pure time and labor that goes to a different direction.
And the beauty of employee ownership, and one of the things that appealed to me about it at the outset, was when people were thinking about how do we deal with this wealth and income gap, it's usually, well, we'll tax the rich and give more to everybody who's not rich in one way or another, if you're a Democrat. And if you're a Republican, it's we'll loosen regulations and we'll cut taxes and that'll create economic growth and that'll help everybody. Neither of these things really ultimately solves the problem, either because they don't work that well, or because they're too expensive.
Or even, what do you think about this, Corey? Or even just saying one of those phrases pisses the other 50% of the country.
They're politically impossible to do anyway.
Yeah, right.
How many books have you read? The final chapter is, if I ruled the world, this is how we would solve the problem. That's great, but you don't rule the world. So your final chapter has to be not what could be done if you ruled the world, but what can be done within a realistic political context.
My God, you should go out to every author, because the amount of people the last 5 years, Corey, of these books that I've been consuming, it's just more people stating their problem, to your point. Not what can we add? Yeah, I love that, man.
So here's an idea that could actually work. And one of the reasons that it can work politically is it is not about rearranging existing wealth. It's about creating opportunities for the ownership of future wealth. It's not taking anybody's wealth away. In fact, the incentives to set up ownership plans make the people who are already doing quite well do quite weller. But what's happening with an ESOP, the core idea of employee ownership, is that the future profits that the employees help create to build ownership in their companies go to the employees. And depending on how, whether the employees own all the company or part of it, either they all go to the company, all the employees, or part of it goes to the employees.
You know what I like? So when I hear objections over the years, Corey, about okay, so you have how do you reward the capitalist risk taker, right? So here's how I always respond to that is like, hey, like the person that took the original risk, or maybe took the risk from, there was the original founder from point A to point B, and then someone else came in and then took the risk from point B to point C, and then maybe point C and transitions to an employee ownership company. Those people got rewarded, especially the tax advantages within an ESOP, 1042, all these different mechanisms that could reward the capital risk taker. And then when you get to this point where the threshold with ESOPs, the leveraged buyout and the structure around it allows it where then there's enough cash flow to allow this to take place, right? And I think about if it's the cash flow that allows the employees to buy it, through future growth. It's the same reason that private equity loves going to companies above 2 million in EBITDA. 2 million, yeah, right. And here's why I say this, Corey, is because at 2 million in EBITDA and above, you can afford to put debt on the books, still hire EY to go in there and fix all the crap that's broken while you sit in the conference room. And if it's that easy, you can still facilitate the employee buyership. So the capital that's at risk is just kind of different by the time you get to a cash flow that size. Well, per se, I'm not. That's not an absolute comment, but
you're right, Ryan. That's a good point, and I think what you're saying makes me think of employee ownership at two stages of a company's life where it's typical. One stage is where the company is getting started, and people have put in a lot of capital and a lot of sweat equity and ideas, and they deserve, if the company succeeds, to be well rewarded for that because they've done themselves good and they've done the economy good. But if I'm in that position, I might say, well, as one wise business owner once said to me, that his real epiphany was stopping to think about how much of the company he owned and to think about how much what he owned was worth. And he said, I realized that if I shared ownership with the people I was working with, that they would help me grow the company and I would own a smaller piece of a much bigger pie. Bob Beister created a company called Science Applications. And that was exactly the way that he approached it. He owned 100% of the company, had 50 employees. And each year, he would give employees ownership in a variety of different mechanisms. They could buy stock. He granted them stock options, eventually set up an ESOP, had all these things working together. When Bob retired some 40-some years later, the company had 20,000 employees and was worth $7 billion. And Bob owned about 2.5% of it. And as he
I'd take 2.5% of 7 billion.
2.5% of 7 billion, he thought was a pretty good deal. And plus, of course, he made money also along the way, and much more than it would have been worth if he was convinced if he'd owned the whole thing. That's an extreme case. But giving away or sharing 10% or 20 or 30% with the employees as the company is growing really is a good idea if you do it right. And what the research shows, and venture capitalists have bought into this at least in the tech industry, is if you're going to give ownership to people, give it to everybody, because the companies that perform the best are the ones that share ownership most widely. That's partly because they tend to have different cultures about employee involvement, partly because people can be more motivated. A big part of it is retention, which is, of course, a crucial attraction and retention, crucial issues, especially for companies relying on knowledge capital. And I would argue that no matter what business you're in, you rely on that.
Right.
To your customers, you're not your intellectual capital. You're who they talk to on the phone or get the email from.
Yeah, I love it. And up to your comment about attraction of employees and such, I think it's back to the incentive alignment. Like, so my wife, Corey, I mean, I've been doing this now for quite a while, and as we sit on our pillows talking about life, and she was not very fulfilled at her last job, decent pay, like the activities, but just a lot of not fulfilling long term for various reasons. Well, when she started looking, I was like literally, what is the point to go work for a company that you don't have equity in? It literally doesn't make any sense. You're just going to waste your time, because you could be making a W-2 salary, then you have to then save after taxes your 401k, which is 19 grand. You 19 grand every year for 20 years, and it's still, who knows if that's enough, but it's after. But if you get that same setup, and then if you put that on an ESOP company, like, you're literally wealthy after 20 years. I mean, it's like just that based on a choice. And I think it's fascinating that you can have all that participation. And I think you hit on a crucial nail on the head, is that there's this perception, I think, Corey, more so now. I mean, you've been doing this all way longer than I have, but like, you say the word fair and people think it's politicized. You know what I mean? Or like, it's like, you're not, and I think you said the main core part is, you're not taking something away from someone, right? Like, right. So she didn't go there and take wealth away from the previous owner or something. You know what I mean? Like, and I think that's a hard thing for people to wrap their heads around.
Well, the other end of employee ownership, the other prime driver, and the largest driver by far, is where you've got an owner of a closely held business who's thinking, no, it's time for me to move on. Or like somebody I talked to the other day is 46, and he just sold his whole company to the ESOP in his company, because I'm not retiring. It was just, I thought this was a good time to cash in, and I'm going to continue to work here and do what I like and be the CEO. So, sometimes even that happens, but usually it's somebody in their 60s, 70s, and they're thinking, now's the time to sell at least part or maybe all of the company. I could sell it to a competitor, and that might work out, but sometimes, of course, one business owner said, I was all set to sell to a competitor, really good price. We were just about to sign the documents, and I said, oh, by the way, what's going to happen to the administrative people? Where are they going to be located? And the buyer said, well, we don't need them anymore. So it was an HVAC company, and about 20 of the 70 employees would be gone. And he said, I couldn't do that. And I walked away. And I thought, there's got to be another way. And I found ESOPs.
That's awesome.
And so that's what he did. So you could sell to a competitor. Maybe you'll get a good price. You could sell to private equity. Chances are you will get a good price. But we know what happens to your company too often with private equity. Not all the time. Sometimes they can be absolutely great, but too often they're not so great. And so what's the alternative? Well, both your competitor and private equity are buying your company for really only one reason. They think that the future profits your company will generate will repay the investment they made, whether that investment is because they borrowed money, which is the usual case with PE, or because they've taken money out of their cash reserves and bought you. So what's an ESOP doing? Well, an ESOP is a mechanism that uses that same concept, as you've alluded to, Ryan, where you use the future profits of the company to buy ownership from you. So it's no different from selling your company to anybody else, except who ends up owning the company. And Congress says, we actually want you to do this. So number one, if you use an ESOP to buy all or part of your company, and that, by the way, is a cool thing. These other buyers, they don't want to buy 30%. You want to sell 30%, you can't, pretty much. You want to sell 30% to an ESOP? Go right for it, because that's an easy thing to do. If you want to sell 100%, you can do that too. So number one, you have to sell the whole company. Number two, these profits that are being used to repay this acquisition cost are not deductible to the PE firm. They are not deductible to any other buyer, but they are deductible if you're an ESOP company.
Which means you're not paying taxes.
So, well, it means if
on the state and federal side.
Well, there is a way. There's a second incentive. If you're 100% employee owned, forget about deductions. You just don't pay any taxes at all. You don't need.
Yeah, because you're talking about the partial. You're doing the deductions, but if it's a whole, you're getting the pass-through K1. You don't pay any taxes. Yeah.
Right. And again, all this depends on how you do it, and there's a bunch of rules. But you can sell to an ESOP and defer taxation on the gain by reinvesting in stocks and bonds of other companies. So let's say you've got a $5 million company. If you were to do that in entirely pre-tax of after-tax dollars, that 5 million, you'd need 7 point something pre-tax. You would take the 5 million, and then you would pay, if you're in California, you'd pay about a third of it. So almost 1.5, about 1.4 million would be due in taxes. You take the 3.6 million and go buy other investments. With an ESOP, you take $5 million in profits to buy $5 million in stock, and you take your $5 million, the whole $5 million, and you go invest in other things, or maybe you give some of it to charity.
Or you put it in an irrevocable trust, and then you get a step up in basis on death, and then you never pay any taxes.
Yes, well, and it doesn't have to be an irrevocable trust. If any of the securities you hold on to until death are stepped up in basis, so then there'd never be a capital gains tax.
Hence the bipartisan nature of this. Employees don't have to write a check because they don't have the capital.
Right.
The original investor risk taker that grew it to create that value gets proportionally paid for what they
get
created.
Fair value plus tax benefits.
Yeah, and Corey, so this is where I could I love how you said 2 ways to change. You need to be able to have change, and it's doable. Is that how you said it? You need to be able to actually make significant change,
and it needs to be politically practical.
Yeah. And I think that this is still something that sits there. And when I think about how I describe this to people when they say, because most people, so many people don't know you have to pay taxes when you sell a company. I literally do these presentations all the time, Corey. I'm like, you can't put the enterprise value on your personal balance sheet for so many reasons. It's probably a third of what the enterprise value is, or a half or something, whatever it is, being dramatic. But when we sell our house, our homestead, we don't have to pay taxes because it's not an investment property. And this 1042, this ability to you're kind of getting treated like, hey, this was your main vehicle of wealth creation. We're giving you a break when you go to monetize it. So that way there's a higher ability to transition that. I think it's
actually I wrote that law. That was the most.
The 1042 is
that's the one I did write. I didn't write the basic ESOP law, but I wrote 1042 because a business owner came to me when I was working on Capitol Hill, and he said, I'm going to sell to an ESOP. I've gotten offers from John Deere, and they would buy my company and give me John Deere stock. They'll pay me more than the ESOP is likely to pay. But also, I would get John Deere stock, and I wouldn't have to pay any taxes until I sold John Deere stock. It's called a Section 368 transfer. You can still do that. So he said, there's an incentive for me to sell to some big company, which means there's a disincentive for me to do the right thing and sell to an ESOP. Now, I'm going to do that anyway. And any new law won't do me any good. But wouldn't it make sense to change this law? I said, well, that makes sense, Ed. And so I said, well, let's create something parallel, where if you sell to an ESOP and you buy stocks and bonds of other companies that you hold, that you can get the same kind of essentially 368 treatment. And so, I went to my boss, was chair of the Senate Small Business Committee at the time, Gaylord Nelson. He was a famous liberal senator. He was the founder of Earth Day. He was one of 2 senators who voted against getting into the Vietnam War. And so his progressive cred was pretty clear. And he said to me, that sounds like socialism. And I said, no, it's not socialism at all. It's everybody being a capitalist. And by the way, I've already talked to Senator Goldwater's staff, and they like the idea. And he said, oh, okay, well, then I think it's great.
Isn't that fascinating? So, question then, because I got the person that wrote the bill here. Why C corps? I mean, was it because of how everything changed over the last handful of years?
Yeah, in 1980, when I introduced the bill, it passed in 1984. You could not have an ESOP in an S corporation. So the reason is S corporations are pass-through entities, unlike C corporations. C corporations pay tax. S corporations say, here's our profits. We're going to pass those on to the owners, and they'll pay the tax proportionally to their ownership. Well, what if the owners are non-taxable? Well, that's not good. That means nobody pays the tax. So an ESOP trust is not a taxable entity. So you couldn't have an ESOP in an S corporation. In 1997, Congress said, well, let's change that so that non-taxable entities can own S corporations if they agree to pay their share of the taxes at the highest personal income tax rate. So they made that change. So now ESOPs could be in S corporations if they paid the taxes. And the next year, Congress said, if an ESOP pays its taxes and then the employees leave the ESOP and eventually get paid out, and maybe they put the money into an IRA, but eventually the money comes out and is taxable, isn't that taxing the income twice? And they said, actually, that's true. So let's not tax the trust, because the employees will eventually get taxed when they get their ownership paid out to them. And so now it became possible to do that. But 1042 didn't apply, this rollover provision didn't apply, because it said you had to be a C corporation, not a partnership. You couldn't be an S because you couldn't have an ESOP, couldn't be an LLC. So that's the political history of that. There have been efforts ever since to change it. And there was a real minor change passed a couple of years ago. In 2027, you can defer 10% of the tax. But politically, it's been a big hill to climb on that, because it's one of the just peculiarities of congressional politics. You have to have any spending bill scored by the Office of Management and Budget, or the Congressional Budget Office. And when they score this, they say, how much would it cost if every eligible company became owned by an ESOP? Well, that would be amazing, but it also ain't going to happen. But so the score is this enormous, billions and billions of dollars in lost taxes, when the reality is it's probably a few $100 million of what would actually be used. But
well, I hope you're enjoying the conversation with Corey so far. You can tell I love this topic about ownership and who owns what assets. How do we grow the value of those assets? How do the workers that are working at these companies grow the value, and how do they participate? How can an owner who took the original risk to create the asset can monetize the business in a way that is fair for them? I just love all of these topics. And I think that if you enjoy these conversations, the Intentional Growth Academy is something you got to check out, because in principle number 3, I break down in crazy detail and whiteboard out how private equity works, how ESOPs work. So if you want to understand how PE firms work, from the general partners raising the funds from the investors to creating the platform, creating the bolt-ons, how they make money within that whole situation, their timeline and valuations, as well as comparing that to ESOPs with how the board works, how they get the funding for the original tranche at the first part of the buyout, and then how employees vest in and how all that's done, how the 1042 works. All of that stuff is in the Intentional Growth Academy. That is normally $14.95. Because you're a listener, and in the show notes, there's a link for $500 off. So it's $9.95 for the do-it-yourself. 10 hours of videos, 71 videos, tons of material in the case studies and podcasts to go with it. So go check out the Intentional Growth Academy if you're interested. So with that said, I'll leave you back to the interview with Corey. Oh, and don't get me started. And by the way, why don't we just print it? Because that's all we do anyways. So it's all fiction based. What's so fascinating, you go back to your comment of you were king for a day of how these books are all written at the end, or the last comment. So what do you think of the effectiveness of it? Because like I've always said over the last handful of years, if I got to make one choice for legislation, I would go up and open up the 1042 for all entities. Because I look at the U.S. Census Bureau, Corey, of the privately held companies, and like this is like, I'm curious if you think that this is if I'm paying attention, if my concern is warranted, I guess is my question is. So when I look at the U.S. Census Bureau of like the amount of companies, and there's 27 million entities, only 6 million of them have employees. Have you seen that kind of breakdown?
It's only the number of companies who are big enough to do an ESOP, which is probably 20 or more employees. There are some smaller ones, and who have an owner who's say 50 or older. And there's certain industries where you can't do it. You have to have actual employees.
You don't need to be 50 or older, right? I mean, because
I'm just saying that the most likely candidates are businesses owned by people 50 or older. You can't have an ESOP for a law firm. So that, there are certain restrictions. If you look at who could be a reasonable candidate, that's about 150,000 companies.
Got it.
Now, it's important to remember that, there's recently BDO, the accounting firm,
I saw it,
became 42% employee owned, and they're on their way eventually to 100%. People say, oh, well, how many companies have ESOPs? Well, they have 10,000 employees. That's 100 employee companies. So we need to think in both terms, but these companies, these 150,000 companies, are a very small percentage of all the companies, but they're a very large percentage of total workforce in private companies.
Got it.
And so that's the eligible group. And I think providing, and most of them are S, but you could convert to C and get this benefit. It's easy to do. I think that would be important. I think it's maybe not the most biggest barrier.
And maybe it's because, like, I mean, how easily it rolled off your tongue of, it's not that difficult to do. The amount of technical advisors that I have
stumbled across. It's not difficult to convert from S to C.
Right.
That's really simple.
Right. And then there's a math equation to be run to say, hey, what does this mean to you? And like, but Corey, like it's kind of back to this whole transactional nature of so many advisors, where it's like, I'm the trusted advisor of a business owner. I'm making a decent amount of money from my friend. And not that that's wrong at all. It's just, oh, by the way, now my friend wants to do an ESOP and I don't make any money off of that. And I want to make my $40,000 to $50,000 on a quality of earnings. And I have no idea how to convert to an ESOP. So like the amount of preconceived notions that I have to dismantle to have a logical conversation with someone. And like even this whole S versus C, business owners just clam up, freak out. Right. And like, because it's like because of the self-interest, that it makes sense, but it's a disheartening because of how easily it rolled off your tongue.
That's exactly the issue. That first of all, setting up that part of ESOP formation is really easy. Setting up an ESOP involves a lot of complexities and costs. So, let's be clear that it's going to cost you $150,000 to several $100,000, depending on the size and complexity of the deal. And people say, well, I don't want to deal with that. I'll just sell my business. You need to be disabused of that notion, because no matter how you sell your business, is going to cost you a lot of money to sell it, and it's going to be complicated. And chances are, if you sell to somebody else, there are going to be contingencies that are not going to be apply if you have an ESOP. So the notion that you can sell your business cheaply in terms of advice is just not true. And because for one thing, you're likely to pay a fee based on the percentage of the transaction to the advisors who help you do it. And if it's 2.5% of a $5 million company, then right there you've paid $125,000 just for the success fee, not to mention the lawyer and the appraiser and the accounting firm and the
how about the deal structure? Honestly, Corey, I've always and here's what I continue to say, and I know it changes with interest rate environments, etc. But if you were to take a ESOP $10 million enterprise value compared to and I don't know what the right number is, Corey, but 12, 14, $15 million enterprise strategic buyer, deal structures and net proceeds, especially if the owner actually wanted to have a couple years of employment where they have a salary and stuff, I'd almost take I would take neck and neck net proceeds, even though it might be $3 to $4 million more.
Yeah.
For enjoying of an experience and net proceeds and control, like the ESOP, probably 65% of the time. I don't know if that's true or not, but
when you factor in the tax deferral, you need to get about a 25% premium.
Is that what it is?
To come out in the same place. I've talked to M&A people, and probably about 10 to 15% of companies could sell to another buyer and end up on a net basis better off than selling to an ESOP and taking the tax deferral. But Ryan, you raise a really important point. When I used to talk to business owners, the first thing I would say is, hey, there's all these great tax benefits for selling to an ESOP. I thought that's what would convince them, until one of our members said, Corey, that's wrong. That's the wrong approach. Most of the people are like me. Their first question is about legacy. Sure, they want to get a fair price. They want to get a decent deal. Getting the absolute highest dollar is less important to them than legacy issues. And those legacy issues might be, what's the role of my company in the community? Maybe my company has strong social values. There are a lot of ESOPs around Holland, Michigan, for instance, because there's a very strong Christian community there that finds ESOPs consistent with their Christian values. Or maybe your company has some strong environmental values that the buyer won't continue.
You know what's another one, Corey, that I think should be part of the legacy conversation is a method or strategy of operating your business. Because I think about there's just top of my head, where you might have a fee-only fiduciary RIA compared to someone that slings insurance. And there's just a fundamental difference of how they're operating their entities that could be a misalignment.
Yeah, that's another part of legacy, is how your employees are treated and how they might be treated if the company were sold to someone else. I hear that a lot from people who choose to do ESOPs. And then, Ron, you raised another increasingly important point, one that I didn't hear a lot before. I guess the ultimate expression of this was two brothers who sold to an ESOP in their 70s, and they had no intention of retiring, which neither of them did until they died at 100 and 102. And
there you go. There's some good genes.
And a lot of people now that I deal with who are in their 60s or even 70s say, well, I want to sell because it's the financially sensible thing to do at this point in my life, but I don't want to quit. I might not want to be the CEO anymore. Maybe I'm an engineer and I want to do engineering work, or there's a particular part of the business I'd really like to work on, or I'd like to work part-time. And an ESOP lets you do that. So that's part of the legacy too.
You know what my business partner always tells, because my business partner did an ESOP. They were in the food brokerage space, Corey. And so they did an ESOP. They ended up selling it to private equity because the PE firm gave them an offer they couldn't refuse. And it kind of triggered this whole process. But to highlight what you just said, because actually it is a huge component of the conversations and like the Visage workshops, the key notes that I give, is like, I think we're finally at this stage because the baby boomers, like this word retirement needs to be rethought. Like no one really agrees that like we're going to sit and do crosswords at Perkins or sit on the beach forever. Like people need a purpose. They need to do something. And so the story we always tell from my partner's old world is it Bob's Red Mill or whatever, the oatmeal guy? Yeah, he was like the mascot at the trade associations, or maybe he still is, but he's like, yeah, he did the ESOP and he still gets all dressed up and goes to the trade association or the trade shows.
In his 90s.
That's awesome.
He's a role model. I can tell you, I'm 74. And I stopped being the director 12 years ago. And after 30 years of being the director, with no intention of retiring, and I still don't have any intention of retiring. And I think a lot of people like me, if you can get up every day with a sense of purpose and you like what you do, that's a blessing. And so a lot of people aren't going to want to retire, or at least they're not going to want to work full time. Maybe they want to work full time, but they want to keep engaged, and it's good for you to do that.
100%, man. And like, who doesn't want that? Like you said, like wake up and have fun every day. And so, what I think is so interesting, this is going to lead to my next question of why don't you think there's more ESOPs, and what is going to be some of our barriers, Corey? But here's what I've been experiencing, and it's really fascinating, Corey, because I've been at this for almost 10 years, trying to help people view their company as an asset. And it took me a long time to even come into that phrase, which is actually resonating with people. And one of the reasons that it's such a we're dealing with psychology here, in my opinion, kind of like that whole investing of the misbehaving of behavioral economics, Corey. And I think you're, based on your research and your material, you resonate with it, is that you have these people that, my dad and I, before we sold our company, Corey, I was in the same boat. We had 100 employees, 20 million in revenue. And my dad kept saying, I want out. I want out. I want out. Every weekly meeting, we're hearing that. And I hear that all the time. People have been calling me for years. And for a long time, I'd try and solve their problem, Corey. And then I realized they don't know what they want out of. And there's this concept. I mean, I did not invent this. Jack Stack talks about, a lot of people talk about it in different ways, but I will not entertain that comment. I'm like, because I say, what do you want out of? Because what I hear, Corey, is most people call me and they're complaining about their job, essentially, not their asset. There's essentially this job or the asset. Are you talking about your job and all the things that have to do with your duties? Or do you want out of your financial asset because there's a risk and you don't know the trade-offs of distributions versus reinvestment? And it's usually this, like, it's all commingled. So now, Corey, what I do is I force everybody in the first part of our workshop or our training and presentations is we have to distinguish our job from our asset, because they can they have totally different paths. So what I'm trying to do is separate like left brain, right brain, and be like, hey, because like the reason I'm going into this is like people that I've engaged with, it's like they think you have to pull the ripcord and you're completely out. They don't know the Bob's Red Mill stuff. Like, you can actually monetize your asset and keep being the mascot if you want, or the complete inverse, where if you wanted to like completely get out of your role, be on the chair and monetize, like, it's just possible to have this combination, and people don't know that, which is therefore they don't even think. So they're kind of leading into, what do you think some of the challenges are of the maybe the psychology behind ESOPs, or like, why are there not more ESOPs given everything we've talked about?
I can't help but remark on Bob's Red Mill that it still lets you, and as in Bob's case, go to, I think it was Scotland, to receive the Golden Spurtle Award.
Well, there's a reason to stay for sure.
Which is the much sought award for the best oatmeal, or as they would say, the best porridge. And the Golden Spurtle is this thing that you stir the porridge with.
That's awesome.
So who wouldn't want that opportunity?
That's a reason to stay 100%.
So, of course, I've thought about this a lot and been frustrated about it a lot for 45 years, is why aren't there more? If it's such a good idea, it works for employees, it works. And when I say it works, I should be clear. Companies with ESOPs grow about 2.5% per year faster than would have been expected, lay off about 1/3 to 1/5 the employees that other companies would, depending on the year. And employees have 3 times the retirement assets, and retention rates are at least twice as high. So yeah, it really does work. And it's got all these tax benefits. So why aren't there more of them? Well, Ron, you nailed a big part of it. And he said the advisor you go to probably doesn't know how an ESOP works very well or at all. And so say, I want to sell my business. I heard about this ESOP thing, or I haven't heard about it at all. Well, if you ask them about the ESOP and they're not an expert, they think, well, if you do an ESOP, you might not use me. So I'm going to tell you that's probably not a good idea. And obviously, not everybody's going to do that, but it's human nature, as you said. And if I don't know, human nature also tends to, if I don't understand something, and I'll bet we've all done this, I've done it. If I don't understand, it's probably not a good idea, because it's kind of work then to try to figure out. So it's easier just to say it's probably not a good idea, I don't bother with it. There are also advisors who, as I said, make their money on a success fee. And sometimes ESOP advisors will charge this depending on what you're looking for from them. But if you go to sell your business conventionally through an M&A or a brokerage firm, they are going to charge you a success fee of 2.5% to 5% of the sale. If you go to them and say, hey, I found a buyer, it's called an ESOP. I just need you to help me set it up. And they say, okay, well, we're going to charge you 3% of the transaction for finding the buyer you just told us about. So, well, I'm not going to pay that. I'm just going to hire the people on an hourly basis. So there's a real disincentive for people to tell business owners that you can do this. And this is a tremendous difficulty. Also, the concept itself takes some explaining. And you've pointed out that sometimes you get these blank stares or people are kind of confused. And I understand that. The core concepts are really quite simple. But most of the people you go to get the introductory concept aren't real good at making the elevator explanation of ESOPs. Mark Twain once said the most boring people are the people with good memories. And
I don't know if I've heard that.
Yeah. And when I used to be a teacher, I remember I was teaching a class on statistical techniques. And I looked at the class, I was like 24 in my first year of teaching, and they were really confused. And I realized to my shock that words and concepts that were second nature to me now were things they didn't understand, nor did I when I was their age. It's hard to remember what you didn't once know. And when you're an expert, it's hard to go back to that really basic conversation. And so people tend to be, it's too complicated. So then the third problem is more of a financial one, where you've got and this is only for some sellers. Some sellers would say, I like the idea of an ESOP. I'm 72, got some health issues. If I want to sell 100% of the company, the bank will loan me part of it. The rest I'm going to have to take a note over several years. I don't know if I can wait several years. I need to get the money up front, or I'd prefer to get the money up front. And there isn't a way to do that. There's a bill in Congress now called the Employee Equity Investment Act. I helped to sort of conceptualize that, but other people are really pushing it. Ownership America, particularly. And that bill would create investment corporations geared towards investing in ESOP companies, either with equity or more commonly with debt. with some.
Like, is it just like mezz financing to replace the seller note or something like that?
Exactly, except that this would have some government guarantee portion.
Almost like an
So
SBA loan
it was just
behind.
like an SBIC
Oh, cool.
investment. So these entities would be just like SBICs, but focused on employee ownership, so that the amount that they could loan would be larger at a lower interest rate and help facilitate some of these transactions. So those two things are things I think that could really move the ball forward. But I do think the most important thing really is just getting people to know what this is. And one of the frustrations, we've talked about how politically nonpartisan this is. It's an idea whose support is extremely wide and extremely shallow. There, with one exception, Dean Phillips from Minnesota. My daughter.
Oh no, that's where I'm at.
Oh really?
I would give you his address.
He's my daughter's congressman, and my granddaughter, who's a teenager, is on his teen advisory council. But Dean Phillips is and Jared Polis, the governor of Colorado, they're big promoters of employee ownership. But other than that, there aren't politicians who say it's not just a good idea, it's an important idea. And that's really lacking. And that's really important for that to happen.
I couldn't agree more. I mean, I like, as I shot you the note, Corey, and then I want to comment on that, just kind of the macro picture, how important it is. And then I want to comment and just tell you a quick story of how, because I love how you broke down what the challenges are, share my experience over the last 10 years, because I think it'd be interesting to hear how you reconcile it. But like from the macro picture, I don't know what else is the solution, right? Like we have now cars make, a Denali for an SUV is 110 grand. I mean, I had a friend that got a quote for their pool for 150. I mean, where are the consumers going to come from if they don't have any money? I just seriously want to know, like, the people in these boardrooms, like, who's going to be buying your stuff? So I literally just want to understand.
That's what Henry Ford asked.
Yeah, exactly. And I'm so going back to, I just want to share with you a quick couple minute story, Corey, of the journey of how I came to the conclusion that you have of kind of the reason that it hasn't taken more traction. And for the listeners, and you might be interested in hearing the story, I don't think it should be too duplicative, but so Corey, like, it's so fascinating. So I got into, after we sold and had gutted the company and just paid a bunch of taxes, all of the experiences that I wish I would have avoided, and I could have done something like this. And so I wanted to go help, other business owners, Bo Burlingham, Small Giants. So that's why I got onto all this stuff, because I was like, there had to have been an alternative way for my father and I, and too late, didn't have all, I was in Vistage, we were 20 million in revenue, had all these advisors that were very skilled and were big shots because of the size of our company. No one brought it up. No one suggested, like, all of the same things that you talked about. So went through all the challenges emotionally and financially selling the company, 5 years to kind of figuring out my life, got to the point where we started our Kona in 2018 with the training program was the first part that we had. And I had called it the growth and exit framework, Corey. And I mean, I got my exit planning certification, you name all these certifications I got. And I kept realizing I was like one of the only previous business owners in any of these certifications. And I'm like, well, has anybody else managed payroll? Like, we had a $250,000 payroll, a couple $1 million in inventory, I mean, like, this is like, it was a machine. And so I didn't know all the technical stuff. So I was getting caught up on that, calling it the growth and exit framework, exit plan, all this stuff is starting to take hold because of the baby boomers and all the advisors wanting more AUM or more transactions or however they were going to monetize this baby boomer issue. Well, what I've now, so fast forward 10 years, essentially, Corey, here's what I have realized after thousands of meetings, hundreds of podcasts, hundreds of keynotes. There's been 500 and to almost 600 people that have been through our training program. The problem that I was having, Corey, I was sitting there and this guy loved our program, and the growth and exit framework binder was sitting on his desk. And he's like, Ryan, I can't have this binder on my desk. And we're not brokers, Corey. Like, we're not investment bankers, not brokers. We're not like, and I had like one of my main mandates is I do not want and will not sacrifice the integrity of our offering to have a tie to an outcome for the owner. Because Corey, if you were a client of ours and you came to me and said, I want to tank this thing in the next 12 months, we're going to help you identify your goal and execute your goal, whatever it is. I don't care. I just want you to get what you want, to be happy because you're the business owner. So when I heard that guy say that, it was like, I mean, truly, I had no vested outcome other than I wanted him to get what he wanted. And it was this word exit. And what happened over and over, and that I realized that because what we had said, people did not know the difference between their leadership role and their ownership role. So they think it's all one. So when they hear the word exit, they think of the ripcord shot out of the parachute, and they think of death, despair. They don't want to retire because of all the reasons we just talked about. And like, it was over and over psychological issues that they had where my company wasn't growing at all. And I changed. So all I did, Corey, is 4 years ago, I changed the program title from Growth and Exit Framework to Intentional Growth, View and Run Your Company Like a Financial Asset, and the thing took off. And isn't that funny? So here's why I got Steve Storkin. Him and I over the last 4 years have built a really good relationship. He did the ESOP mini series with me, and he went through our program. And I was like, Steve, here's what's going on. Because like, Corey, out of the 500 some people that have been through the program, half of them want to do an ESOP.
Wow. We need more.
Think about. And well, and this is why I think it's like what you had said is so spot on, because I'm hearing. So here's what's happening, Corey, is the people that used to call me every day and say, I want out, they have no energy. They're totally burnt out. And usually the company is a pain in the ass for cash flow, working capital, and they're just strapped from cash, energy, good people. And then if I were to look at you and be, hey, Corey, you're burnt out. By the way, all you have to do is, put all your money back into the company for 5 years, hire a new CEO, launch a new product, put a new ERP system, and then you can get the valuation you want in 7 years. And you do an ESOP, you get half up front. And they're like, Ryan, I just told you I hate this company. So what's interesting, Corey, to me, because it's a psychological thing, is I have these people coming through the program. So what's super fascinating about the program title is Intentional Growth, View and Run the Company Like a Financial Asset. So people are coming to us now who want to grow with the end in mind, which is creating an asset that they have choices with. So it's not exit. We're not hammering this exit. Principle number 3 is understand your exit options and how it impacts your valuation, your timeline, and what you want from your legacy. So it's happening, Corey. And here's what's fascinating, because we're leaning into the entrepreneur psyche, I think, is if you build a good company and the intrinsic financial value of your company based on the future cash flows, not some strategic premium or some gutting of the company, but you build a good company. What a concept. While you have energy and capital and time, you can at least have your point B. So here's what I'm trying to encourage everybody is if you wanted to get to 2 million in EBITDA and the 6 multiple at $12 million in 6 years, even if you don't want to do an ESOP, wouldn't you still like to monetize your company? And they're like, yeah. I'm like, look at this is 100% in control of you. As long as you invest in the right things that you're tracking on the way there. So these people are excited because they have control. And if they can hit their financial freedom number, Corey, with half of the money at closing. And here's the second part of this. So as people are now gravitating towards that concept, it's one of the big components of our program that I didn't realize was one of the main sticking points is how are we as entrepreneurs or business owners or investors supposed to plan for our future if we don't know what our stuff is worth? And so many entrepreneurs who are not from Wall Street don't know how valuations work. So a disproportionate amount of our training teaches on how the EBITDA and future multiples work because they didn't know how to actually impact that value because it was some advisor that pulled it out of their unicorn's butt and said, here's your valuation. It's an 80-page report. And they're like, I just know how to sell copiers, which is what my dad and I did. So it's this weird psychological thing where through education, the owner's taking more control. They realize how valuations work and they have enough time. So it's just this fascinating deal. And then what they're allowed, what I'm watching, Corey, they have the confidence and resources to spot the CPA, banker, wealth manager who says you shouldn't do one for a selfish reason. It's just a psychological, it's so fascinating to me, Corey, because if someone calls me up and says, I want out, and they don't have time, it's just like, well, it's because when they don't have the time and they're burnt out, Corey, I see that the valuation is not going to be where they want it to be. And it's too late at that point.
Right. Right. That's true.
Anyways, I just thought I'd share that because I just thought like literally what started that whole chain of dominoes was changing the title. It's legitimately it.
Yeah. It's small changes can make big differences.
What do you, as we're getting to a close here, what do you anticipate as the next couple big moves, or what you're excited for or hope for as you, with the book that you wrote? I mean, like, you're still doing this 13 years after you quote unquote retired. So what are the big things that you're focused on?
When I was growing up, the newspaper in Denver, there was a quote from the founder of the paper saying, "There's no hope for the satisfied man," which has always kind of resonated with me. And I understand that there always has to be something else to strive for. And we've made a lot of progress with employee ownership. There's 14 million people participating in ESOPs and maybe 20 some million in other forms altogether, in forms of broad-based ownership. It's really changed a lot of people's lives. You talk about Jack Stack and SRC Holdings, which just celebrated its 40th ESOP anniversary by announcing their stock price has grown a cumulative over 1 million %.
What is it? What's the share price now? Because I think when he was on the podcast, he told me, because he's been on it twice, Corey, he said it was 1 penny when he did it. And then it was it was like $1,600 a share or something like that, I think.
Yeah, I forgot, because it's split a number of times. So the split and adjusted number is really big. So yeah, there's been a lot of accomplishments. There's been a lot of people leaving with hundreds of thousands of dollars or more from employee-owned companies, and the companies have done better. And if you go to our conferences, you'll see a lot of excited people who will just like leading employee ownership companies a whole lot better. It's more fun than leading a conventional company. So lots of really good things. The idea spread to the UK, where it's growing even faster there than it is here. We're seeing states start to pass employee ownership legislation, but we're still at a tiny percentage. If you look at just the percentage of ownership in private companies that are ESOP owned, there's about 6,000 companies with about 2.5 million employees. All the other employees of that 14 million are in public companies that have much smaller ESOPs. Why isn't there 5 times that number, 10 times that number? And it's frustrating. I think the most important things that we can do are to get that information out there. And this is what you're doing, is one way to do that. There was a bill I wrote in 1987, and in 2002 it became law, called the Work Act. Sometimes you just have to persist.
Oh my God, good for you.
It became law, and it provides funding for states to create the sort of thing Steve Storkin is doing, create employee outreach programs at the ground level in states. It would be a huge deal. It passed, but it hasn't gotten funding yet. And we don't know if it will get funding. So write your congressman, fund the Work Act. Getting more states to do what Colorado and Washington have done, to have programs to spread the word, but also to help cover some of the initial feasibility costs of doing these plans. This can be enormously helpful in smoothing the process. So if you're really motivated about employee ownership, go talk to your state legislator and say, hey, here's an idea I can give you. We can help you. We can give you sample legislation. Other states have done this. It's bipartisan. It's something you can hang your hat on and say, hey, I did this. So we'd love to see more of that happen. But if you have people listening to this who like the idea, the single best thing that you can do immediately is go tell other people. Hey, I heard this podcast. I heard about this website. I read this book. It's a really interesting idea. Let's talk about it.
Well, I'm glad that I was able to help in that mission. And yeah, so to Corey's point, share this podcast with one person that you think might be interested. And then if people are really curious, you can always check out, and we'll put in the show notes, the 4-part miniseries that Steve Storkin and I did. Corey, after I've been doing these workshops, people are like, oh, I'm really interested. I'm like, well, there's literally 9.5 hours of interviews with me and Steve and all these people. So like people can dive into the technical parts of it, but I think you did a really good job at painting the big picture here.
And you can go to our website. It's nceo.org. There's lots of information from basic to complicated, depending on where you are. We have lots of stuff that you can get without being a member and more stuff if you join. And if you are a member, you can contact us anytime with questions. We have conferences, workshops, webinars, all sorts of resources for you.
Corey, thank you so much. We'll have all those links in the show notes. I appreciate being on. I have one final question, and I've asked hundreds of people this question of what intentional means for them, because it's the name of the show. And I'm curious. So intentional, what comes to mind when you hear that word?
I love that word. I think that's a really important thing to think about. And for me, as I said, ever since I've been in the working world, my intention, hopefully I've made some progress on that, is to do something that makes other people's lives better. Because I think there is nothing for me, and I suspect for most people, that makes you feel better about the life you've lived than feeling that you've made other people's lives better.
Well, on that note, I don't know if there's anything else that should be said. Corey, this has been an absolute pleasure and honor. Thank you for everything you've done, Ryan, over the decades.
All right. Thank you so much.